I've taken all the data, and this is what I think the outcome is. Why did prices come down all year? Because they were pricing in recession. Now, if we're pretty much at the point of recession, they will price in recovery. But I don't think it's going to be that complicated. So macros, everyone suddenly learned, as they have to understand what macro is. The world is driven, this whole space is driven by liquidity and network adoption. So the adoption of blockchain technology is ongoing and relentless, but the liquidity of how much money's around drives the space. So once you understand that, you understand a lot about the space. So last year was a massive withdrawal of liquidity. All the money came out, the central banks were tightening rates, all the banks stopped lending money, all of that stuff, and it meant that all assets went down. And crypto goes down the most because it's the kind of longest duration, highest risk asset. So where are we now? So here we are right near the end of the rate hikes. The economy is probably going into recession and pretty soon. And so what happens is the markets start to look forward and say, maybe they'll stop tightening liquidity and take the foot off our necks. And maybe things, because our job in financial markets, particularly in macro, is to live in the future. Looking around today is useless. But looking around, what is the world going to look like in 6 months' time? Are the Fed raising rates in 6 months' time? Almost a 0% chance. Because inflation has peaked, growth is falling, we're going into recession. Normally, they would cut rates at that point. Now, they might be a little bit slow to do that because they really, really want to see inflation lower. But it means that the rate of change of all these rate hikes and all this bad news starts slowing down. And so we're going to get to the point they're going to say, okay, enough. Meanwhile, China's been leading this. The Chinese economy seems to be a year ahead of everybody else's right now. And they started some stimulus process before their lockdowns. And now they've really started to stimulate because, they'd shut down their economy. So we're already seeing this global money supply, and people can see me post this on Twitter from time to time, global money supply year on year and Bitcoin price year on year. They mirror each other. So when liquidity starts to come back in the system, prices start to rise again. So we're at that point, which is why I've been really interested. So in crypto, we've seen that I thought June was the low, and it was in ETH, some stuff, other stuff, no. But the point being is we've thrown the worst possible news. Prices kind of stopped going down. And now we're starting to see liquidity when everybody else is saying, can't you see, you idiots, you're going into recession. How can you own JPEGs when you go into recession? The point being is our job is to look a little bit further into the future. There's certain things going on. One is that things like retail sales are driven by the total amount of volume of goods. Now, because prices have gone up a lot, the volume can have gone down and it still looks like, hey, presto, everything's okay. But it's not. Everyone's selling less stuff. So there's these weird things around inflation that we've not had to deal with. And unemployment's a bit sticky, but GDP growth is still, by last measure, still positive. We had a couple of scares, a scare earlier last summer. But for me and my forward-looking indicators, it looks like it's all about to collapse. That's growth is going to collapse. Now, the markets might get a bit unnerved by that, but again, usually they should look forwards. Most people want to go back to the 1970s because that was the ghost of the baby boomers past, right? So that's why J. Powell, classic baby boomer, his ghost is, I'm not going to be Arthur Burns. I'm never going to let inflation come back. Right, that kind of weird inflation went down, then went up, then went down, then went up, was, I think, a demographic phenomena by these baby boomers, right? They all came into the workforce at the same time. They're all about 30 years old when that happened, and they all started, they were in their 20s and 30s, and they all started consuming stuff, and it was the largest population bulge in all history. I think the actual best comparison is post-World War II. Now, we're going back a long way here, but why World War II? So the pandemic shut everybody out of the workforce, and factories couldn't produce goods any longer. So we have this supply issue, and everyone came back out and went, I want to buy stuff. I've been locked in my house for so long. World War II was that, but bigger. And so what happened is all the factories were making munitions, and now they had to suddenly spin up and make washing machines, and it took them ages to get everything sorted out, and supply chains were broken, and the ships were all blown up, and all of that stuff. But people came in and they wanted to buy stuff. They had some optimism again. and prices rose 20%. So CPI inflation got to 20%. What happened 2 years later is it went negative because this wasn't demand-led.
Right.
It was just this weird supply-demand imbalance that happened for a short period of time. I think the reality is they're fighting the wrong thing. You know, if we think about inflation now, well, we've got a bunch of really older people, which are the baby boomers, who are coming out of the workforce in record numbers. Labour force participation rate, i.e. the number of people in the workforce, is shrinking. And then we've got globalization plus technology in the middle of all of this. And that means that generally speaking, I mean, we've seen this bloody chat GPT-3. I think we have a recency bias. So we talked about the Federal Reserve with their one ghost.
My ghost.
Right, the ghost of your generation is 2008. The ghost of my generation is 2000. All these VCs who are a little bit older, who are in their kind of 40s, they're like, oh my God, this is 2000 all over again. Tech crash, everything's going down 90%. Everybody else is like, well, obviously, what a recession means is that all the banks go bust, everything goes bust. That's not normal. My first recession was 1990. Stock market went down 28%, GDP growth contracted by 2%, house prices fell, and people got tipped out of jobs. Standard recession. Lasted a period of time, the world moved on. That's what I think we've actually got here, is a very ordinary recession driven by Federal Reserve raising rates and prices going up too fast, which means that people can't buy as much stuff because your wages aren't going as much, and so everything slows down. Where's the big imbalance, right? We don't have this, you know, the banking system got sorted out a lot. They're just not allowed to lend as much money. So we don't have those imbalances. So it's very hard to see what's really going to blow up. Now, the bears who are still going, oh my God, this is the worst thing ever, are saying, well, earnings need to come down further. And therefore we've got another leg lower. This is 2000 all over again. We're just not the same level of overvaluation of stuff. Yeah, we were overvalued, but that whole COVID boom has come off. If you look at something like ARK, it's gone back to where it was. You know, crypto has corrected to the bottom of its logarithmic channel. Everything's got back to where it should be. I think this is a false narrative that the level of interest rates matter. What really matters is the rate of change. So when interest rates go from 0.5% to 4%, you really notice it fast until you adapt, right? So companies get a bit leaner, they're able to afford stuff, all that kind of stuff. But I don't think a 4% level of rates stops companies being built or growth happening or anything else. So I'm not sure that that's really the case, that the interest rate issues stop this. And, you know, do you think you would not invest in AI because interest rates are 4%? No, that's bananas.